Welcome back, guys. Yet another Market in Focus, this time wrapping up the week, August 11th. A lot of things happened this week, so let's not waste any time and get right into it. If you stick around to the end of the video, I will have a full trade idea on a new energy-related play that you guys are going to be able to hold, hopefully for a few months going into the end of Q4. It's a great setup. Stick around to the end, and I'll give you the full rundown on that. My name is Hamilton. I'm here with the Trading Initiative. If you like this type of content, please like and subscribe. It helps me out so much. I've had great responses from you guys. So without further ado, let's get into it. This week, wrapping up, yields up, something that we've been talking about. This is a theme, right? There's sector rotation going on. Been talking about this for 4 to 5 weeks. If you go back and watch some of the previous Market in Focus, we want to get the hell out of Dodge and growth names if yields start to pop up because they suffer a lot and yields are popping up. Week over week, up 2.88%, 3 months, 22.41. This is not great for growth stock. Ironically, Bitcoin is up week over week, though. Not something that we would normally expect when the yields are popping up, but it has shown resilience. Not sure why, but I'm not mad about it. For those of us still holding those Riot, Mara, BitF, MSTR, Bitcoin mining, Ethereum mining trades, this is great for us. We understand that those Bitcoin miners and crypto miners move in tandem with Bitcoin, but they're a lot more volatile. If you want to learn how to trade Bitcoin and make more money by not trading Bitcoin, but trading the equity version, making upwards of 400% more on the same type of move, check out the video that I just posted yesterday. Great trading vehicles to capture this type of price action. Crude, week over week, up another 0.64. It's been a volatile week, boys, and crude was caught in the volatility as well, but we are clearly in an uptrend week over week. We are hitting higher highs, and that is directly influencing our decision to be long energy stocks. Once again, stick around to the end and I'll show you an energy stock that is breaking out into potential new highs that you can trade, that you could probably sit in for a few months. It's going to be a good trade here. Looking at the rest of the market though, weakness, right? Weakness. We've talked about this seasonality, pre-election year. I'm sure you've read all about that, but August to September, basically until Memorial Day, the markets tend to just fizzle out a little bit. There's less volume. There's more volatility because there's less hands playing. To be honest with you, it's called Wall Street holiday for a reason. Bankers leave. They go to the hand. They go have fun in August. This is a seasonally weak period of the market, and we expected that and have traded that. Throw on top of that a pre-election year, and you're going to get even less volume and even, more stagnant price action, right? So set your expectations for the next half of August that it's probably just going to be a lot slower and potentially choppy. So S&P 500 down on the week 0.31, but the Q's down 1.56. Once again, there is no reason to be holding mega cap growth right now outside of long-term investments. If you're a trader and you're long this stuff, you're buying the dip, you are fighting a trend that is now breaking to the downside at the very minimum in the short term. I think you're going to have a lot of pain if you're holding those mega cap growth stocks. We're going to look at those in a sec when we go through trading view. It's just not worth it right now. The one area of the market that I don't like popping down though is that IWM, the Russell 2000. There's a lot hinging on the small caps right now. We're going to see that in a second when we look at factor analysis. We see a lot of overperformance in some of the small caps, specifically in the value side, right? Regionals, energy, industrials, but the small cap growth stocks are getting absolutely slaughtered. And that is not a great sign for people that are looking to add risk into the market because typically small caps lead the market in terms of that risk tolerance, right? So emerging markets down, copper down as well. Not something we would normally like to see in uptrends, but this is the hand that we're dealt and we can't complain about it. We just have to trade it, right? So let's talk through a few multi-time frame analysis type charts here. We're going to focus on the 3 month and the 1 month moving forward. No more year to date. Let's just segment off the last 6 months and let's look at the next 5 months here up until the end of 2023. The last 3 months have shown that although trading mega cap growth and growth stocks in general has been very fruitful for a majority of Q2 and into Q3, the trends changed, right? We saw sectors start to rotate at the beginning of July, even though the mega cap stocks continued to go up, the breadth started to deteriorate. That's why we started to get an exit plan. We didn't time it perfectly, but holy shit, it feels good not to be long these stocks right now. We made the right decision. But over the last 3 months here, we see energy popping up, and there's a reason why we went long energy at the beginning to middle of July. That was the right call. Now all the positions that we are in are really starting to work. I'm going to show you in a second a sample of those positions that we're in. Energy is the leading sector right now. I don't know if energy is going to be the leading sector through the end of Q4, but generally these trends take a few quarters to play out before they start to die down. And so there definitely is an opportunity for energy to lead through the end of Q3, which is, we're already halfway through the end of Q3, which is crazy to think about, and potentially into Q4. So energy is outperforming everything on the 3 month basis here, about to eclipse consumer discretionary, but not everything is energy, right? Financials have caught a bid. They've kind of fizzled out a little bit over the last few weeks, but we are still long JP Morgan. We are still long some regional banks. Those trades are up and over 100% still. They're free with profit, so we want to continue to let those things play out. But we would expect financials to pop up, all right? We would expect this because in an environment where the 10-year yield is rising, a lot of these things outperform. Financials are going to be one of them. Industrials is another area that we have some exposure in. Once again, fizzling out a little bit, but from a stock selection process, for example, we're long Caterpillar. That has outperformed, which is great. We want to be long the areas of the market that are catching a bid and not drawing down right now. Right now, that is energy, that is industrials, that is financials. We have a couple positions in materials. Although they aren't performing amazing, I do expect them to perform better than growth on the back half of the year. So we did grab a little bit of exposure. Healthcare as well, not performing as well as we had hoped. But once again, these are areas of the market that are not going down. And that's what we want to be long in a bull market. We do not want to short anything in a bull market. It's just recipe for a blown account. We want to be long areas of the market that are catching a bid, even if they're a little bit slower, because eventually they do catch up. And so we are long some healthcare related names as well. Let's go ahead and niche down to the 1 month and just look really quick at the outperformance in energy. If you're inside TTI, congratulations. If you watch these markets in focus and you've been able to grab this, congratulations. This is why we do what we do. We look at sector strength, we look at industry strength, and we take positions based off of that. OIH and regional banks, those are the two things right there I was just talking about. OIH, oil services, regional banks up there as well. This is why we do not want to close these positions, even if they are stalling out slightly. They are greatly outperforming on the 3 month. We absolutely nailed this sector rotation in terms of energy and banks. We do not want to give up these types of entries unless we are absolutely getting kicked out on an absolute basis, and we're not. XOP, oil and gas exploration and production. These are your three main industries over the last 3 months. There's no reason to close these. We caught them early. Congratulations. Semiconductors we're going to look at on an absolute basis on TradingView, but look at this rollover. Not great from a semiconductor outperformance standpoint, considering this is the more volatile area of the tech market. If semiconductors are breaking down on the 3 month, you have to assume tech is going to break down as well, and it is. Software is breaking down. Internet is breaking down. Tech in general, not a great place to be long right now. And realistically, anything underneath SPY right now, not really a place you want to be long in general. You don't want to be. Specifically in a bull market, you want to be long the areas that are pressing up in a bull market, not down. So things like gold miners, lots of people love to buy these, these parts of the market. Until we see relative performance pop up, there's no reason to do so. Niching down into the 1 month, once again, not going to spend too much time here. Look at the things at the top. It's oil and banks. Look at the things at the bottom. It's solar, clean energy, and actually jets, something that we didn't expect. We did take a position in jets and we did get kicked out. We took a Delta, and I believe some guys took an American Airlines. We ended up closing those for minor losses. We did not get the follow through. This is an industrial component, but for whatever reason, jets did not follow through on the breakout. So it's not all perfect, and that's okay. You don't need to win every single trade. All right, let's look at factor analysis. This gives us a great view of market caps against the S&P 500, specifically, which ones are outperforming right now. On the 3 month, you can see that IWN is outperforming everything right now, at least against the S&P 500 benchmark small cap value. What do you think is inside small cap value? It's regional banks, it's energy, it's industrials, etc. That's why we're along those specific areas. We do have exposure in small and mid caps because they're outperforming right now. Generally, they're higher beta names as well, which makes them easier and more fun to trade. Lower beta names, not saying we don't trade them. We definitely do, but they're just a little bit more boring. And that's okay. You just have to set expectations from the beginning that they will take a little bit longer to get going. But IWN, small cap value, outperforming everything on the 3 month, and look at small cap growth down here, underperforming everything. There's a reason why we don't have any small cap growth exposure whatsoever from a group standpoint. It's because it's just not working. Going to the 1 month here, we have small caps, the value pop up 2.56. And once again, that divergence there with small cap growth down 2.13. You just don't want to own this stuff. All of the data is sitting here saying, don't own this stuff. Don't own this stuff. And yet people still try to buy this dip. I don't know what's going to happen through the end of the year. I have no idea. But what I do know right now is it's not worth owning this stuff until you start to see some uptrends. And right now we are not seeing them. All right. So let's actually go over to TradingView really quick and let's go through some of this stuff here. A few main charts here. I think the big chart of the week is crude oil, right? We've been talking about crude oil for a while. We finally got the break above 83 and we are currently trending upwards. Taking all of the geopolitical stuff out, taking your opinion out, taking bias out, this is an uptrend. That's it. You're north of the 200-day moving average. It's starting to slope to the upside. You're hitting higher highs on a yearly basis. This is a yearly high. You have to assume it's going to continue to go up until it doesn't. I don't give a shit about macroeconomics. I don't give a shit about geopolitics. I don't care about Putin. I don't care about the Saudis. All I care about is which direction is price going and are we breaking significant levels? Yes, we are. We're inside a bullish momentum regime. The market loves oil right now and therefore we love oil right now. So this is a very significant chart. I want to show you something really quick. If we actually look at the correlation between, use this correlation coefficient indicator on TradingView, it's absolutely incredible. And you go ahead and just type in XLE, which is obviously the energy sector, and you look at the correlation between the price of crude oil and the price of energy stocks, specifically US domestic energy stocks. Look at that. Anything above 0 is a positive correlation, and the closer you get to 1 is a 1-to-1 correlation. So is it reasonable to assume that if oil continues to break out to the upside, that energy stocks are going to continue to break out to the upside? Absolutely yes. There is some alpha there for you guys. If one of those breaks out, you can reasonably assume the other one is going to break out. If you want to argue one leads the other, feel free. Right now, oil stocks did lead the breakout in oil prices. So there you go. Just proved it to you. If you like buying uptrends, oil is in an uptrend and XLE is in an uptrend as well. Let's actually look at XLE really quick. Massive distribution fractal turned into a potential breakout here. Look at this. We've been on top of this stuff from pretty much day one when this started to break out. It feels really, really good to be long this area of the market right now with oil starting to break out. And we are near an all-time highs. This is an all-time high here back in 2014. We are pressing into a potential 9-year high here. We don't need more than maybe $85 to $90 a barrel to hit new 9-year highs. And if we break 90, there's an opportunity for energy stocks to hit all-time highs. We do not need oil at $100+ a barrel to hit all-time highs in energy. We're already close, and energy is only trading at $83, $84, or oil is only trading at $83, $84 right now. The correlation is insane, and there's an opportunity here to really knock it out of the park over the end of Q3 and into Q4 with these energy-related stocks. So let's actually talk through a few of these that we're long right now. This is the big winner. This is the grand slam that we're in. We're in MPC. Listen, I'm not going to lie to you. This is a grand slam trade. This is going to end up probably being one of the best trades that we've taken this year. This is an all-time high breakout MPC. You can see it absolutely is screaming. The contracts are up in between 100 and 200% right now, and we are already hitting our first profit target. But as I'm telling the guys in TTI, when you find yourself in an A+ setup that is absolutely screaming at you, don't sell, don't sell. You have no idea where this is going to go. We chip profit very conservatively because we do not want to get out of this type of trade. This is the type of trade, like I said, that could define your year, and we grabbed it off the 135 breakout. Currently trading 149. This is the sector leader in the mega cap, the large cap space in oil. Congratulations to the guys inside of TTI. I had mentioned this trade in particular on YouTube as well, so if any of you guys are listening to that and you're in it, congratulations. You can buy me a coffee at some point. TRGP is yet another trade that is working out really well for us. This is a 1.5-year breakout high, and we're up and into 8-year highs here with TRGP. One thing I want you to look at really quick, consider, is this is a gas distributor name, and that MPC play is an oil refining and marketing name. Now, the industries on TradingView can be a little wonky sometimes, but what I'm trying to show you is we are diversifying across the energy sector. We're not strictly buying only certain types of energy companies. We're trying to diversify within that. We don't want to buy only, for example, oil, gas, exploration, and production names. We want to try to diversify through that, and we are. So MPC, TRGP, 8-year high here, and a follow through off of this $80 breakout. And then once again, APA is another name that we have guys off of this bullish reversal here. Integrated oil name, fantastic name, trading above its 200-day moving average and heading up. This was just a great snag. Look at the RSI. It's a higher ADR name. It's fantastic. So to show you guys some of the stuff that we have here in that oil space, you can see we have MPC 136%, TRGP 83, APA 173. We have a bunch of 100% plus winners. So these are now free trades that they can ride through Q3, Q4 because most of us have January contracts. You see Brian here up 141.9%. VET, one of the names, but haven't shown it, 74%. TRGP, VET. You can see what I'm talking about here. We went long energy a while ago and it's working out, right? So try to catch these things as early as you can. Dixie, another chart we have to be focused on. Is this a failed breakdown right here? If this is, and the Dixie continues to pop up and go over the 200-day moving average, this is a huge detriment to growth stocks, but stocks in general. We want to see the dollar breaking down to see stocks rally, and right now we are not seeing it. That's why this market is incredibly challenging. You cannot play, Q3 and Q4 with the same playbook that you played with Q1 and Q2. The dollar was going down or sideways the entire year. Now all of a sudden it's not. We're breaking key levels to the upside and potentially testing that 200-day moving average. It's going to get very, very challenging. Along with the 10-year, the yields are potentially going to be breaking out. Think about the environment you're trading in. Do growth stocks enjoy when yields break out? Absolutely not. You don't get to choose what the market's going to do. You only get to choose what you do in accordance to what the market is doing. So do yourself a favor and understand that as yields break out and the dollar goes up, growth stocks generally don't go up. Whether you want to short those or not, feel free. We do not. We don't short things in bull markets. We simply avoid trading them. There's no reason to be long there. A little bit of alpha for you here. EQRR, I've mentioned this before. This is an this is an ETF that goes through, it mimics a NASDAQ type of index that encapsulates a bunch of stocks that have positive correlations to a rising 10-year. So once again, if you're thinking the 10-year is going to continue to break out, which it does look like, you can use this EQRR ETF to really deep dive some of the stuff here. I already typed it into Koifin. I'll give you a snapshot really quick on what we're looking at. Go to the 1 month and go through returns, and you can see what types of returns have really done the best here. Look at the type of sectors that are doing well: energy, materials, industrials, energy, financials. This is a huge cheat sheet for you guys. Look at the names of the companies and the sectors that do well when raising, or when the 10-year is raising. There's an incredible amount of alpha there for you guys to dive into. Once again, that's ticker EQRR. The last thing I really want to talk about before we go through the trade idea is the weakness in tag, right? So if we look at XLK in general, take this off of the line chart. There was a huge divergence. We don't normally sell just based off of divergences, but we had to identify the fact that there was slowing momentum in this uptrend. Once we hit all-time highs, and with other factors coming in, we decided to close our positions. That was the right play. We did it almost at the perfect time. I'm very proud of us for how we were able to do that. Right now, there's an incredible amount of weakness in tech. There's no reason to be owning this stuff until we find a floor, reset the RSI, and start an uptrend again, right? But I do want to point out, XLK obviously is not equal weighted, right? This is majority Microsoft and Apple. I think they constitute nearly 50%. So what can you do as a trader? Find a better opportunity in the market. If you do like growth, you can look at the equal weighted ETF, RSPT. So this is going to weight Microsoft and Apple the same as all of the other companies within the ETF. It does look a little better than XLK. XLK has a lot more room to fall, but we should expect that. Mega caps have outperformed through Q1, Q2, and not necessarily some of the names inside of tech. It's really Apple, Microsoft, Nvidia, etc. that have outperformed. Look for a potential pullback here at support. That does give this thing an opportunity to bounce. I don't think that's out of the realm of possibility, but how long is it going to take for it to get down? I think that's the big question. I think it could be, a few weeks to potentially find and build a base on that previous resistance, now turn support before legging up. This is still a bull market, right? This is just a cycle inside of a bull market with sectors rotating. I don't think growth is done. I just think from the short to intermediate term, there's no reason to be trading these things. So if you stuck around to the end, let's go through the trade idea. This is a little bit longer of a video than I wanted, but I hope you guys are enjoying this. Let's go through PBF. You probably saw it at the beginning when I pulled up TradingView. This is a trade that we put on the books on Friday, and it's still valid. So if you like that energy idea, you like the idea of owning energy stocks in an environment where the 10-year yield's going up, the dollar's going up, and oil's going up, here's a trade that is just breaking out above 48 right now, and we expect this thing to run towards potentially 60. So this is a relatively newer energy-related stock. It IPO'd, it looks like, in 2012. So there's data going back about 11 years, and we're almost at an all-time high here, right? So massive fractal here we can buy the breakout of above 48. I would, if I were you, kind of ignore this previous price action back here. There's really not a lot to it. If we look at the VRVP, there was really no volume up there. And realistically, guys that were buying in 2018 probably aren't waiting to sell at break even. There's too much time that's passed. So I would not worry about that and think about this as a potential all-time high breakout. Above 48, stop somewhere below 44.50, can tighten it up a little bit, and that price target's going to be up near 60 bucks. Bullish momentum regime, right? We're coasting above the 50 going back to the middle of May, and it's a higher beta name, which is what we like here, right? You're not trading something super slow. You're trading a 3.59 ADR. We go ahead and look at the market cap here. You can see it's a mid cap, average volume 2.37 million. This is a great trading vehicle to express a bullish thesis in a rising oil environment. Energy stocks continuing to break out. Another thing, you're post ER, but you do have a div coming up. So generally a div is going to offer you a short-term pullback. You want to wait to try to time that. Doesn't always happen, but generally speaking, when div days hit, people sell their stocks after they collect that dividend, and it does cause a short-term pullback in that. So you might be able to snag a better entry here. If we look at the chain, just highlight what we bought, right? We've been buying this for the last 2 sessions, 3 sessions. The $60 calls make the most sense here. It's a 0.32 delta. You can get long at 272. On that pullback, you might be able to snipe it for a little bit lower. If that's too expensive, you might be able to go out to the 65s and sell it. Just be careful because the open interest isn't that much, but this is a 4-to-1 setup, right? You're targeting that same PT we found on the TradingView, the chart rather. It's a 4-to-1 setup, max loss $100, max profit 400. So it's a very, very nice setup here on that 4-to-1. But I prefer straight calls here if you can wing it. Why? Because IV is below 50 and IV rank is 0.2. And if you do get the breakout, which we're expecting, if the breakout materializes, we expect IV to pop, not get crushed, but pop. And if you're in a straight call, you're going to get the premium on the contract is going to get hit positively in 2 ways. Obviously, the direction you take the trade up and an IV expansion. So you're going to be able to get paid in 2 ways. Call debit spreading that is going to hinder the ability to capture that IV expansion. So once again, great setup, guys, inside of TTI. I've been buying it for the last few days. I still think this is early. There's no reason why you can't grab this on a pullback, but we expect big things out of PBF. As always, do it like TTI does. Set an order on the books at 100%, sell half of the position. That way you can ride the rest of the position up risk-free towards your price target without any stress. Guys, if you like this type of content, please like and subscribe. Leave some comments below. Does this help? We have nailed it. Unfortunately, these videos don't get enough views. I like making them. The guys inside of TTI love them, but on YouTube, they don't stick very well. This is not the most engaging content, but I'm a very fucking good trader, and I try to set you guys up well in advance of these big moves. So leave comments below. Let me know what you think, and I'll catch you next video.